Hello and welcome. For generations, the world of investing felt distant, almost mythical for the average person. It was a world of roaring trading floors, complex charts on glowing screens, and exclusive conversations behind the closed doors of Wall Street firms. The idea of buying a piece of a major company felt like something reserved for the wealthy, the well-connected, or those with a specialized degree in finance. It required a broker you'd meet in person, significant amounts of capital, and a level of complexity that was intimidating, to say the least. But in the last decade, a quiet revolution has taken place. It didn't happen on Wall Street. It happened in Silicon Valley, and it spread to the palm of your hand. That revolution is the investment app. Suddenly, the complex world of stocks, bonds, and funds has been distilled into a user-friendly interface on your smartphone. The gatekeepers have been replaced by gateways. Today, you can be sitting on your couch, waiting for a coffee, or on your lunch break, and with just a few taps, you can participate in the global economy. This series is dedicated to demystifying that very process. Over the next several chapters, we will explore from the ground up how these US investment apps actually work. Before we dive in, it is absolutely crucial to establish the purpose of this series. The information provided here, and in all subsequent chapters, is for informational and educational purposes only. It is not, under any circumstances, to be considered financial, investment, legal, or tax advice. The world of finance is complex and highly regulated. Personal financial situations are unique, and what might be suitable for one person may be entirely inappropriate for another. Therefore, it is essential that you consult with a qualified and licensed financial advisor, a certified public accountant, or a legal professional before making any financial decisions. Our goal is to empower you with knowledge about the tools, not to tell you how to use them for your specific situation. By understanding the mechanics, you can ask better questions and have more informed conversations with the professionals you choose to work with. So, with that vital understanding in place, let's begin with the most fundamental question. What exactly is an investment app? At its core, an investment app is a software program on your phone or computer that provides a user interface to a brokerage firm. Think of it like this. The app itself is the digital storefront. It's clean, well-organized, and designed to make your shopping experience pleasant. But the app doesn't actually hold the products in the backroom. The products, the stocks, the exchange-traded funds or ETFs, the bonds, are managed and executed by the company behind the app, which is a licensed broker-dealer. This is a key distinction. The app is the technology layer, the portal you interact with. The company running the app is a financial institution that has to be registered with and regulated by government bodies like the Securities and Exchange Commission, or the SEC, and the Financial Industry Regulatory Authority, known as FINRA. These organizations set the rules to protect investors and ensure the market operates fairly. So when you download an app from a well-known company, you're not just getting a piece of software. You're opening an account with a regulated financial firm that has the legal authority to buy and sell securities on your behalf, based on your instructions. The app is simply the tool you use to give those instructions. Instead of calling a person on the phone and saying, "Please buy 10 shares of company X for me," you tap a button on your screen that sends the same digital command. How does this process work behind the scenes? When you decide to buy a stock, let's say 1 share of a popular tech company, you open your app. You search for the company, see its current market price, and enter the number of shares you want to buy. When you confirm the purchase, your app sends a secure, encrypted order to your brokerage firm's trading system. This system then routes your order to a stock exchange, like the New York Stock Exchange or the NASDAQ, or to other market centers where that stock is traded. In a fraction of a second, your order is matched with a corresponding sell order from another investor somewhere else in the world. Once the transaction is complete, the brokerage firm updates your account. The cash is deducted, and the ownership of that 1 share is now recorded in your name within your brokerage account. The app then updates its display to show you that you are now a shareholder. It sounds incredibly complex, but modern technology has made this process nearly instantaneous for the end user. What used to take phone calls, paperwork, and days to settle can now happen in the time it takes to refresh a web page. This newfound accessibility is the single biggest impact of investment apps. They have drastically lowered the barriers to entry. In the past, you might have needed thousands of dollars just to open a brokerage account. Many firms charged high commissions for every single trade you made, sometimes $50 or more, whether you were buying or selling. This made it impractical for people to invest small amounts of money. Today, the landscape is completely different. Many apps have no account minimums, meaning you can start with as little as $5 or $10. Furthermore, the industry has largely moved to a zero-commission model for stock and ETF trades. This means the direct cost of buying and selling these common securities has, in many cases, been eliminated for the retail investor. We will dedicate an entire chapter later in this series to understanding how these apps make money if not from commissions. But for now, it's important to recognize this fundamental shift. This series will be your guide through this new world. In the upcoming chapters, we will break down everything. We'll discuss the different types of investment apps, from those designed for active traders to those focused on long-term, automated investing. We will explore the various types of assets you can invest in through these apps. What are stocks, bonds, ETFs, and mutual funds, really? We'll cover the critical topics of risk, diversification, and the psychology of investing. We will also delve into the nuts and bolts of setting up an account, understanding the different account types like individual accounts or retirement accounts, and navigating the features you'll find inside the app. We'll also cover the crucial but often overlooked topics of security and insurance, like SIPC protection, which helps protect the assets in your account. The journey from being a curious observer to a knowledgeable participant in the financial markets has never been more accessible. The tool is in your pocket. The goal of this series is to help you understand the blueprint of that tool, to see the machinery working behind the simple interface. So, to recap what we've covered in this first chapter, investment apps are not just software. They are user-friendly portals to regulated brokerage firms. They have revolutionized investing by lowering costs and removing traditional barriers, making it possible for millions of people to access the financial markets directly from their smartphones. This process works by translating your taps on a screen into official trade orders that are executed on the stock market in seconds. The power these apps provide is immense, but it comes with a responsibility to be informed. This is not a game. It is the real-world mechanism for allocating capital and building wealth over time. In our next chapter, we will take the first practical step: choosing your digital brokerage. We'll discuss the key factors you should consider when comparing different investment apps, so you can understand what to look for in a platform that might align with your educational goals. Thank you for joining me, and I look forward to continuing this journey with you. Welcome back. In our first chapter, we pulled back the curtain on how U.S. investment apps transform your smartphone into a direct link to the financial markets. We established that these apps are sophisticated yet user-friendly portals to regulated brokerage firms, allowing individuals to participate in the economy like never before. Now that we understand the basic mechanics, a logical and important next question arises. With so many options available, how does one even begin to understand the differences between them? This chapter will serve as a guide to navigating that landscape. We will explore the key characteristics and features that differentiate one investment platform from another. The goal is not to recommend any specific app, but to provide you with a framework of knowledge. This framework will help you understand what to look for and what questions to ask as you research these platforms on your own. And to reiterate the essential point from our introduction, this information is for educational purposes only. It is not financial advice. Evaluating and selecting a brokerage is a personal decision that depends on individual circumstances. We are here to map out the territory, not to chart your specific course. Always consider consulting with a qualified financial professional to discuss your personal situation. So let's explore the primary factors that define an investment app. We can break this down into a few key areas: the underlying investment philosophy of the platform, the costs and fees involved, the tools and resources it offers, and finally, the crucial aspects of security and user experience. First, let's talk about the investment philosophy. Broadly speaking, investment apps in the US tend to fall into one of two major categories. The first category is designed for the self-directed investor. These are the platforms that give you the most control. They provide you with the tools to research, select, and manage your own investments. You decide which individual stocks, ETFs, or other securities you want to buy or sell, and you execute those trades yourself. These apps are like a well-stocked hardware store. They give you access to all the tools and materials, but you are the one responsible for building the project. They are geared towards individuals who want to be hands-on with their investment decisions. The second major category is often referred to as robo-advisors or automated investing platforms. These services take a different approach. Instead of asking you to pick individual investments, they typically start by asking you a series of questions to understand your financial goals, your timeline, and your comfort level with risk. Based on your answers, they use algorithms to build and manage a diversified portfolio for you, usually composed of low-cost ETFs. This is a set-it-and-forget-it approach, designed for those who prefer a more passive, hands-off experience. Rather than building the project yourself, you are hiring an automated service to build and maintain it for you according to a pre-agreed blueprint. Understanding which of these two philosophies, hands-on or hands-off, aligns with your own interest and learning style is a fundamental first step. Next, let's delve into one of the most critical areas to understand: costs and fees. While many apps famously offer zero-commission trading, it's important to know that this doesn't mean the services are entirely free. Brokerages are businesses, and they generate revenue in various ways. A key part of your research is to understand an app's fee structure. You might encounter several types of fees. For self-directed platforms, while stock and ETF trades might be commission-free, there could be fees for trading other assets, like mutual funds or options. There might also be account maintenance fees, though these are becoming less common, or fees for transferring your assets out of the brokerage. For robo-advisors, a common fee structure is an annual advisory fee, which is charged as a small percentage of the total assets they manage for you. For example, a fee of 0.25% per year on a $10,000 account would be $25. It's also vital to look at the fees of the underlying investments themselves, particularly the expense ratios of ETFs and mutual funds, which we will dedicate a full chapter to later on. The key takeaway here is to read the fine print. Look for a page on the company's website titled Pricing or Fees, and review it carefully to understand how the business makes money. The third area of consideration is the platform's toolbox, the research, data, and educational resources it provides. Different apps cater to different needs. Some offer sophisticated charting tools, in-depth financial data, and professional analyst reports, designed for users who want to perform deep analysis on their own. Others might focus more on providing a wealth of educational content, like articles, videos, and tutorials, aimed at helping beginners learn the fundamentals of investing. Some platforms may have very basic features, showing you little more than the price of a stock, while others offer a fire hose of real-time data. There is no single best set of tools. The value of these resources depends entirely on what you, the user, find helpful for your own educational journey. Finally, and perhaps most importantly, is the matter of trust and security. As we mentioned in Chapter 1, legitimate brokerage firms in the United States are regulated entities. Before even considering a platform, you should verify that it is a member of the Financial Industry Regulatory Authority, FINRA. You can do this by using the Broker Check tool on FINRA's official website. This confirms the firm is registered and provides a history of its conduct. Furthermore, you should ensure the brokerage is a member of the Securities Investor Protection Corporation, or SIPC. SIPC is a non-profit corporation that protects the securities and cash in your account up to $500,000, including a $250,000 limit for cash, in the event the brokerage firm fails financially. It is crucial to understand that SIPC does not protect against market losses from your investment decisions. It protects you if the firm itself goes out of business. Think of it as insurance for your account against the failure of the institution holding it. Any reputable brokerage will clearly state its FINRA and SIPC membership on its website, usually at the bottom of the page. Beyond regulation, consider the app's user experience and security features. Is the app easy to navigate? Is the information presented in a way that you find clear and understandable? Does it offer security features like two-factor authentication to protect your account from unauthorized access? A well-designed app can make the process of learning and monitoring your account a much more straightforward experience. So, to summarize Chapter 2, when learning about the landscape of investment apps, it's helpful to use a framework. First, understand the platform's core philosophy. Is it built for a self-directed, hands-on user, or for a passive, automated experience? Second, investigate the full picture of costs and fees beyond the marketing headlines. Third, explore the toolbox of research and educational resources to see what the platform offers to help you learn. And finally, always verify the firm's regulatory standing with FINRA and its SIPC membership for your protection. By using these categories as a guide for your own research, you can move from being overwhelmed by choice to being empowered with a clear set of criteria for evaluation. In our next chapter, we will move from the platform to the account itself. We will discuss the different types of investment accounts you can open, such as a standard individual brokerage account versus tax-advantaged retirement accounts like a Roth or traditional IRA, and explain the fundamental purpose and rules of each. Thank you for listening. Hello and welcome back to the series. In our previous chapter, we created a framework for understanding the landscape of investment apps, focusing on their philosophies, fees, tools, and security. We learned that choosing a platform is the first step in building your gateway to the financial markets. Today, we take the next logical step. Once you've understood the platform, you need to understand the container where your investments will actually be held. This container is your investment account. It's a common misconception to think that all investment accounts are the same. In reality, the type of account you choose is one of the most significant decisions you will make, as it determines the rules, regulations, and especially the tax implications of your investment activity. In this chapter, we will demystify the most common types of accounts you can open through a U.S. investment app. As we are about to discuss topics that touch upon taxation and long-term financial planning, our standard disclaimer is more important than ever. The information provided here is strictly for educational and informational purposes. It is not, and should not be interpreted as financial, tax, or legal advice. Tax laws in the United States are incredibly complex, subject to change, and depend entirely on your individual circumstances, such as your income, filing status, and state of residence. Therefore, consulting with a qualified tax professional like a certified public accountant, CPA, or a licensed financial advisor is essential before opening any investment account. Our objective is to explain what these accounts are, not to advise on which one you should choose. The first and most common type of account is the standard brokerage account, often referred to as a taxable brokerage account. This is the most flexible and straightforward type of investment account. There are generally no restrictions on how much money you can deposit into it each year, and you can withdraw your money at any time, for any reason. When you hear about people buying and selling stocks on a regular basis, they are typically doing so within a taxable brokerage account. The key word here is taxable. When you sell an investment in this account for more than you paid for it, the profit you make is called a capital gain. These gains may be subject to capital gains taxes. The tax rate can depend on several factors, including your income and, crucially, how long you held the investment. The distinction is usually between short-term capital gains, for investments held 1 year or less, and long-term capital gains, for investments held more than 1 year. This is the fundamental trade-off of a taxable brokerage account. You get maximum flexibility, but you must be mindful of the tax consequences of your activities within the account. Now, let's shift our focus to a special category of accounts designed with a specific goal in mind: retirement. These are known as tax-advantaged retirement accounts. The U.S. government created these accounts to encourage people to save for the long term. To do this, they offer significant tax benefits as an incentive. In exchange for these benefits, however, these accounts come with a stricter set of rules, particularly regarding contributions and withdrawals. The two most common types you'll find in investment apps are the traditional IRA and the Roth IRA. The letters IRA stand for Individual Retirement Arrangement. First, let's look at the traditional IRA. The core concept of a traditional IRA is tax-deferred growth. Here's how it generally works. Depending on your income and whether you have a retirement plan at work, the money you contribute to a traditional IRA may be tax-deductible in the year you make the contribution. This means it could lower your taxable income for that year, potentially reducing the amount of tax you owe up front. Once the money is in the account, any growth from your investments, dividends, interest, or capital gains, is tax-deferred. This means you do not pay any taxes on that growth year after year. The taxes are deferred or postponed until you retire. When you begin to withdraw money from the account in retirement, typically after age 59 and a half, those withdrawals are then taxed as ordinary income. The trade-off is clear. You potentially get a tax break now, and your money grows without being taxed along the way, but you pay taxes on it when you take it out later in life. Next, we have the Roth IRA. The Roth IRA essentially flips the tax proposition of the traditional IRA on its head. Contributions to a Roth IRA are made with after-tax dollars. This means you do not get an upfront tax deduction for contributing. You are funding the account with money that has already been taxed. The primary benefit, and it is a powerful one, comes later. Just like a traditional IRA, your investments within a Roth IRA grow tax-free. You won't pay taxes on the growth each year. But here is the key difference. When you take qualified withdrawals in retirement, again, typically after age 59 and a half, among other rules, that money, both your original contributions and all the investment growth, is completely tax-free. The idea is to pay the taxes now, on your contributions, in exchange for tax-free income in retirement. Both traditional and Roth IRAs have annual contribution limits, which are set by the IRS and can change over time. There are also rules about early withdrawals before retirement age, which can often result in taxes and penalties. Furthermore, there are income limitations that may affect your ability to contribute to a Roth IRA or deduct contributions to a traditional IRA. To summarize the core difference in a simple way, with a traditional IRA, you might get a tax deduction now, your money grows tax-deferred, and you pay taxes on withdrawals in retirement. With a Roth IRA, you get no upfront deduction, your money grows tax-free, and your qualified withdrawals in retirement are also tax-free. The choice between a taxable account, a traditional IRA, and a Roth IRA is a foundational element of financial planning and depends heavily on your personal financial picture, your income, and your expectations for the future. Many individuals have more than one type of account to serve different financial goals. It's important to note that these accounts are just the wrappers or containers. The investments you hold inside them, the stocks, bonds, and funds, are a separate choice. You can hold the very same investments in a taxable account as you can in an IRA. The difference is how the returns from those investments are treated by the tax code. In our next chapter, we will finally open these containers and look at what you can actually put inside them. We'll begin breaking down the most common types of investments available through these apps, starting with the one that is most familiar to everyone, stocks. We will explore what it truly means to own a share of stock in a company. Thank you for joining me. Hello and welcome back. In our last chapter, we detailed the different types of accounts you can establish, drawing a clear line between flexible, taxable brokerage accounts and the rule-based, tax-advantaged retirement accounts like IRAs. We described these accounts as the containers for your investments. Today, we're going to start filling those containers. We'll begin with the most well-known and foundational investment asset in the financial world, the stock. You hear the term every day on the news, in conversations, and you see stock tickers scrolling across screens. But what does it actually mean to own a stock? This chapter is dedicated to answering that fundamental question. Before we proceed, a reminder that this discussion is for educational purposes only. We will be describing what a stock is as a financial instrument. This is not a recommendation to buy or sell any particular stock, nor is it a guide on how to select stocks. The value of stocks can fluctuate, and they carry inherent risks. Any decision to invest in stocks should be made after careful personal research and, ideally, in consultation with a licensed financial professional who understands your individual situation. At its very core, a share of stock represents a small piece of ownership in a publicly traded company. The simplest way to visualize this is to think of a company as a giant pizza. When the company decides to go public, it means it is cutting that entire pizza into millions, or even billions of tiny equal slices. Each one of those slices is a share of stock. When you buy a share of a company's stock, you are buying one of those slices. You become a part owner or a shareholder of that business. So why do companies do this? Why would a successful business sell off pieces of itself to the public? The primary reason is to raise money, or what is known in the financial world as raising capital. Imagine a growing coffee shop chain that wants to expand nationwide. Building new stores, hiring staff, and marketing requires a huge amount of money. Instead of just taking out a loan from a bank, the company can choose to issue stock. By selling these small ownership stakes to investors, the company receives a large infusion of cash that it can then use to fund its growth, develop new products, or pay off debt. In return, the investors who bought the stock now have a claim on the future profits and assets of that company. Once a company's stock is available to the public, it trades on a stock exchange, like the New York Stock Exchange or the Nasdaq. This is where the price of a stock is determined. A stock's price is not set by the company itself. It's determined by the constant, real-time interaction of supply and demand. If there are more investors who want to buy a stock, demand, than there are who want to sell it, supply, the price will generally go up. Conversely, if more people are selling than buying, the price will tend to fall. What influences this supply and demand? A multitude of factors. The company's performance is a major one. Things like its revenue, its profits, and how much debt it has. The health of the overall economy, the performance of the company's specific industry, breaking news events, and even general investor sentiment, can all play a significant role in moving a stock's price. The key takeaway is that a stock's price is dynamic, constantly fluctuating based on new information and changing expectations about the company's future. Now, if you own a stock, there are generally two ways you can potentially realize a financial return. The first is called capital appreciation. This is the most straightforward concept. If you buy a stock at, say, $50 per share, and over time, its price rises to $60 per share, the value of your investment has appreciated by $10 per share. If you choose to sell it at that higher price, you realize a capital gain. The second way is through dividends. Some companies, often larger, more established ones, choose to distribute a portion of their profits directly back to their shareholders. This payment is called a dividend. It might be paid out every quarter or every year. Not all companies pay dividends. Many younger, high-growth companies prefer to reinvest all of their profits back into the business to fuel further expansion. Receiving a dividend is like getting your small share of the company's profits delivered to you in cash. However, it is absolutely critical to understand that these potential returns are not guaranteed. There is always the other side of the coin, risk. The price of a stock can go down just as easily as it can go up. If the company performs poorly, if it faces unexpected challenges, or if the economy enters a downturn, the stock price can fall below what you paid for it. It is entirely possible to lose money on a stock investment. In a worst-case scenario, if a company goes bankrupt, its stock can become completely worthless, and an investor could lose their entire investment. This is the fundamental risk-reward trade-off of stock ownership. Ownership gives you a claim on the company's potential success, but it also exposes you to the risk of its potential failure. Finally, it's useful to know that there are typically two main types of stock: common and preferred. The vast majority of stock traded by individual investors through apps is common stock. Owning common stock usually gives you voting rights, meaning you can vote on major company decisions, like electing the board of directors. Preferred stock is a different class of ownership that typically does not come with voting rights. However, preferred shareholders have a higher claim on the company's assets and earnings. This means if the company pays dividends, preferred shareholders get paid before common shareholders. To recap this chapter, owning a stock means you are a part owner of a business. Companies issue stock to raise money to grow. A stock's price is driven by market supply and demand, which is influenced by a vast number of factors. And finally, while stocks offer the potential for growth through appreciation and dividends, they also carry the inherent risk of loss. Now that we have a solid understanding of what an individual stock is, our next chapter will explore a popular type of investment that was designed to manage the risk of owning just one or a few individual stocks. We will be diving into the world of exchange-traded funds, or ETFs. Thank you for listening. Hello and welcome back. In our last chapter, we took a deep dive into the concept of a stock, understanding it as a slice of ownership in a single company. We also acknowledged the fundamental trade-off. The potential for growth that comes with ownership is directly linked to the risk associated with that single company's fortunes. This naturally leads to a critical question. How can one participate in the market's potential while managing the risk of being tied to just one or a few companies? The answer lies in one of the most important concepts in modern finance: diversification. You've likely heard the old saying, "Don't put all your eggs in one basket." In the investment world, this is a core principle. Diversification is the strategy of spreading your investments across a wide variety of assets to reduce risk. The idea is that if one investment performs poorly, the impact on your overall portfolio is cushioned by the performance of your other investments. Today, we're going to explore one of the most popular and accessible tools for achieving instant diversification: the exchange-traded fund, or ETF. As always, this chapter is for informational purposes only. We are explaining the mechanics and concepts behind ETFs, not recommending any specific ETF or investment strategy. The suitability of any investment depends on an individual's unique financial situation and goals. For personalized advice, please consult with a licensed financial professional. So what is an ETF? Let's go back to our basket analogy. If a single stock is one egg, an ETF is like a pre-packaged basket containing dozens, hundreds, or even thousands of different eggs. An ETF is a single fund that holds a collection of underlying assets, most commonly, a wide variety of stocks. When you buy just one share of an ETF, you are instantly buying a tiny fractional piece of all the different companies held inside that fund. Let's use a well-known example to make this concrete. Many popular ETFs are designed to track the performance of a market index, such as the S&P 500. An index is simply a benchmark that represents a segment of the market. The S&P 500, for instance, is an index that includes 500 of the largest publicly traded companies in the United States, spanning across many different industries like technology, healthcare, finance, and consumer goods. An S&P 500 ETF, therefore, is a fund that aims to hold the stocks of all 500 of those companies in roughly the same proportions as the index itself.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
So when you buy one share of this ETF, you are not betting on the success of a single company. Instead, you are gaining exposure to a broad cross-section of the entire US economy. Your investment's performance is no longer tied to one egg, but to the collective performance of 500 of them. This is the power of diversification in action. One of the key features of an ETF is right in its name: exchange-traded. This means that, just like an individual stock, shares of an ETF are bought and sold on stock exchanges throughout the trading day. Their prices fluctuate in real time based on supply and demand. This makes them different from their older cousins, mutual funds, which are typically priced only once per day after the market closes. While many ETFs track broad market indexes, there is a vast universe of them. Some are designed to track specific sectors of the economy, like a technology ETF or a healthcare ETF. Others might focus on international stocks, or on different asset classes entirely, like bonds or commodities. This variety allows for many different approaches, but it's important to understand that a narrowly focused sector ETF is, by definition, less diversified than a broad market ETF. Now you might be wondering, how do the companies that create and manage these funds make money? This brings us to a crucial term to know: the expense ratio. An ETF is not free to operate. There are administrative and management costs involved in maintaining the fund and ensuring it accurately tracks its index. The expense ratio is an annual fee, expressed as a percentage of your investment, that covers these costs. For example, an expense ratio of 0.03% means that for every $10,000 you have invested in the fund, you would pay about $3 per year in fees. When comparing ETFs that track the same index, the expense ratio is a key point of comparison, as these fees directly reduce the fund's return. It is vital, however, to understand that diversification does not eliminate risk. ETFs are not risk-free. If the overall market that the ETF tracks goes down, the value of the ETF will go down with it. For example, if the entire S&P 500 index falls by 10%, an ETF that tracks it will also fall by roughly 10%. Diversification helps protect against the specific risk of a single company failing, which is known as unsystematic risk. It does not protect against systematic risk, which is the risk of the entire market declining. To recap this chapter, diversification is a fundamental strategy for managing investment risk. An ETF is a powerful tool that allows an investor to achieve instant diversification by purchasing a single share that represents a basket of many underlying assets, like stocks. Most common ETFs are designed to track a market index. Their prices fluctuate all day on stock exchanges, and they have an annual fee called an expense ratio. While ETFs help manage single company risk, they are still subject to the risk of the overall market. Now that we understand stocks and ETFs, in our next chapter we will explore another major asset class that plays a very different role in the world of investing. We will turn our attention to the world of bonds. Thank you for listening. Hello and welcome back. So far in our series, we have focused on the concept of ownership through stocks and ETFs. We learned that when you buy a stock, you become a part owner of a business, sharing in its potential profits but also its risks. Today we turn our attention to a completely different type of asset, one that is built not on ownership, but on lending. Welcome to the world of bonds. If stocks represent equity, bonds represent debt. They play a distinctly different role in the financial markets and in an investor's portfolio. This chapter will explain the fundamental mechanics of what a bond is and how it works. As always, this information is for educational and illustrative purposes only, and should not be taken as financial advice. The bond market has its own complexities and risks. Any decision to invest in bonds should be made after conducting thorough personal research and consulting with a qualified financial professional who can assess your individual circumstances. So, what happens when you buy a bond? In the simplest terms, you are lending money to an entity. That entity could be a corporation raising money to build a new factory, or it could be a government raising money to fund public projects like roads and schools. In exchange for your loan, the issuer of the bond makes a promise to you, the bondholder. This promise has two main parts. First, to pay you periodic interest payments over a set period of time, and second, to return your original loan amount at the end of that period. Let's break down the three key components of a bond. First is the face value, also known as the par value. This is the amount of the loan that will be repaid to you at the end of the bond's term. Think of it as the principal amount of the loan. Second is the coupon rate. This is the fixed interest rate that the bond issuer agrees to pay you on the face value of the bond. For example, a $1,000 bond with a 5% coupon rate will pay the bondholder $50 in interest each year. These payments are typically made semi-annually. This predictable stream of income is one of the primary characteristics that attracts people to bonds. Third is the maturity date. This is the specific date in the future when the bond matures, and the issuer repays the face value of the bond in full, ending the loan. The term of a bond can range from very short, just a few months, to very long, such as 30 years or more. Putting it all together, when you buy a bond, you lend the issuer an amount of money. In return, you receive regular interest payments, the coupon, for a predetermined length of time, and at the maturity date, you get your original investment back. Just like with stocks, there are different categories of bonds. The two most common types are corporate bonds and government bonds. Corporate bonds are issued by companies, while government bonds are issued by national governments. In the United States, bonds issued by the federal government are known as treasury bonds, or simply treasuries. Because they are backed by the full faith and credit of the U.S. government, they are widely considered to have a very low risk of the borrower failing to pay back the loan. Corporate bonds, on the other hand, carry a higher level of risk because a company's financial health can change. This brings us to the crucial topic of risk in the bond world. While bonds are often perceived as being safer than stocks, they are not risk-free. There are two primary risks to understand. The first is credit risk, or default risk. This is the risk that the bond issuer will be unable to make its promised interest payments or repay the face value at maturity. If the company or entity you lent money to goes bankrupt, you could lose some or all of your investment. To help investors assess this risk, independent agencies provide credit ratings for bond issuers. A higher credit rating signifies lower perceived credit risk. The second major risk is interest rate risk. This is a more complex but vital concept. It describes the inverse relationship between bond prices and prevailing interest rates. Here's how it works. If you buy a bond with a 3% coupon rate, and a few months later, new bonds are being issued with a 5% coupon rate, because interest rates in the economy have gone up, your 3% bond is now less attractive. Why would someone buy your bond paying 3% when they can get a new one paying 5%? To sell your bond before its maturity date, you would likely have to offer it at a discount, meaning its price on the open market would fall. Conversely, if interest rates fall, existing bonds with higher coupon rates become more valuable. To recap this chapter, a bond is essentially a loan made to a corporation or government. It is defined by its face value, its coupon rate, and its maturity date. While bonds can provide a predictable stream of income, they are not without risks, the most significant of which are the credit risk of the issuer defaulting and the interest rate risk that can affect a bond's market price. In our next chapter, we will discuss the concept of risk in more detail and explore how investors think about balancing risk and potential reward across different asset classes like stocks and bonds. Thank you for listening. Hello and welcome back. In our last two chapters, we introduced two of the primary asset classes available to investors: stocks, which represent ownership, and bonds, which represent debt. We touched upon the idea that they behave differently and carry different levels of risk. Today, we're going to formalize that idea by exploring one of the most fundamental principles in all of finance: the risk and reward trade-off. Understanding this concept is like learning the basic physics of the investment world. It provides the context for why different assets are expected to perform the way they do over the long term. As we are discussing a theoretical framework for evaluating investments, it is important to remember that this entire discussion is for educational purposes. It is not a guide on how much risk you should personally take, nor is it a recommendation for any particular investment strategy. A person's relationship with risk is deeply personal and should be explored carefully, often with guidance from a qualified financial advisor. The risk and reward trade-off is the principle that, in a competitive market, an investment can only offer higher potential returns by also carrying a higher potential for risk. There is no such thing as a high return, no risk investment. If it sounds too good to be true, it almost certainly is. Think of it outside of finance for a moment. Learning to ride a bicycle has a certain level of risk. You might scrape your knee. The reward is a convenient and enjoyable way to get around. Learning to skydive, on the other hand, carries a significantly higher level of risk, but for those who do it, it offers a much greater thrill and sense of accomplishment. The potential reward is correlated with the potential risk. In investing, risk can mean several things, but it's most often defined as volatility, the degree to which an investment's price swings up and down. An investment with low volatility might move like a gently rolling hill. An investment with high volatility might move more like a jagged mountain range with sharp peaks and deep valleys. This volatility represents the uncertainty of the outcome. A riskier asset has a much wider range of possible future values, both positive and negative. Let's place the assets we've discussed onto a conceptual spectrum of risk and reward. On the very low end of the risk spectrum, you would typically find assets like cash or U.S. Treasury bonds. Because Treasury bonds are backed by the full faith and credit of the U.S. government, the risk of default is considered extremely low. As a result, the potential return, or the interest they pay, has historically been lower than other asset classes. Moving up the spectrum, you might find high-quality corporate bonds. These are still loans, but they are made to corporations instead of the government. Because even a stable company carries more default risk than the U.S. government, these bonds must offer a higher interest rate, a higher potential reward, to attract lenders. Further up the spectrum, we find diversified instruments like broad market ETFs. As we learned, these funds hold a wide basket of stocks, which smooths out the specific risk of any single company failing. However, they are still composed of stocks and are subject to the volatility of the entire stock market. Therefore, they are considered to carry more risk than bonds, and historically, they have offered higher potential long-term returns to compensate for that risk. At the higher end of the spectrum is the ownership of individual stocks. When you own shares in just one company, your potential for reward is immense if that company is successful. But your risk is also concentrated. If that one company fails, your investment could lose all its value. This represents a high-risk, high-potential reward position. This brings us to the human element of the equation, risk tolerance. Risk tolerance is a measure of an individual's personal ability and willingness to endure the potential for losses in their investments. This is not a technical term, but a personal one. It's about how you, as an individual, would feel and react if you saw the value of your investments decline. Several factors can influence a person's risk tolerance. One is their time horizon. This refers to the length of time you expect to hold an investment before you need to access the money. Someone with a longer time horizon may feel more comfortable with volatile investments, having more time to recover from potential downturns. Another factor is a person's financial goals. The nature of the goal can influence the investment approach. Finally, there's a purely emotional and psychological component. Some people are simply more comfortable with uncertainty than others. Understanding your own risk tolerance is a critical piece of financial literacy. The purpose of knowing about the risk-reward trade-off is to recognize that building an investment portfolio is about finding a balance you are comfortable with. It helps you understand why a portfolio of bonds is expected to behave differently from a portfolio of stocks. To recap this chapter, the risk and reward trade-off is a foundational principle stating that higher potential returns are associated with higher levels of risk and uncertainty. Different asset classes, from government bonds to individual stocks, occupy different positions on this risk spectrum. Finally, an individual's own risk tolerance is a key personal factor in navigating this landscape. In our next chapter, we'll get practical and look at the process of actually buying and selling an investment through an app. We will explore the different types of orders you can place, such as market orders and limit orders. Thank you for listening. Hello and welcome back. In our last chapter, we explored the foundational principle of the risk and reward trade-off, understanding that different asset classes offer different profiles of volatility and potential return. With that theoretical framework in mind, it's time to get practical. Let's say you've done your research and you're ready to make a transaction. You open your investment app, you navigate to the stock or ETF you're interested in, and you hit the trade button. What happens next? You'll be presented with a screen that asks for more than just the number of shares you want to buy or sell. It will ask for your order type. This chapter is dedicated to demystifying these order types. They are the specific instructions you send to your brokerage, and understanding how they work is a crucial piece of financial literacy. As we discuss the mechanics of trading, please remember that this information is for educational purposes only. We are describing the function of these tools, not advising on when or how you should use them for your own investments. The choice of which order type to use depends on the specific goals and strategy for any given transaction, and should be made with a clear understanding of your own objectives. The two most fundamental order types you will encounter are the market order and the limit order. Let's start with the market order. This is the simplest and most common type of order. When you place a market order, you are essentially telling your broker, "Buy this security for me right now at the best available price," or "Sell this security for me right now at the best available price." Your priority with a market order is speed and certainty of execution. You want the trade to happen as quickly as possible. In a stable market for a highly traded stock, the price you get will likely be very close to the last price you saw quoted on your screen. However, it's important to understand a concept called slippage. The price of a security can change in the milliseconds between you hitting the button and your order being executed on the exchange. For this reason, the final execution price might be slightly different, a few cents higher or lower, than what you expected. During times of high market volatility, this slippage can be more significant. With a market order, you are guaranteed that your trade will execute, but you are not guaranteed a specific price. Now let's look at the alternative, the limit order. A limit order gives you control over the price of the transaction. When you place a limit order, you are telling your broker, I only want to buy this security at a specific price or lower, or I only want to sell this security at a specific price or higher. Let's break that down. A buy limit order sets a maximum price you are willing to pay. For example, if a stock is currently trading at $50.50, you might place a buy limit order at $50. This means your order will only be executed if the stock's price drops to $50 or below. If it stays above that price, your order will not be filled. A sell limit order sets a minimum price you are willing to accept. If you own that same stock, you could place a sell limit order at $51. This instructs your broker to sell your shares only if the price rises to $51 or higher. The trade-off here is the opposite of a market order. With a limit order, you have control over the price, but you give up the certainty of execution. There is no guarantee that the stock will ever reach your specified limit price, and if it doesn't, your trade will never happen. Beyond these two primary types, you may also encounter another tool, known as a stop order, often called a stop-loss order. This order type is designed as a risk management mechanism. A stop order is an instruction that remains dormant until the security hits a specific price, called the stop price. When the stop price is reached, the stop order is triggered and automatically becomes a market order. The most common use is a sell stop loss. Imagine you own a stock that you bought at $100. You might place a sell stop loss order at $90. This does nothing as long as the stock price is above $90. However, if the stock price falls and touches $90, your stop order is triggered, and it immediately turns into a market order to sell your shares at the next available price. The purpose is to attempt to limit a potential loss. It's crucial to understand that because it converts to a market order, the execution price is not guaranteed to be exactly your stop price. In a rapidly falling market, the sale could execute at a price below your stop price. Finally, you'll often be asked to specify the time and force for your limit or stop orders. The two most common options are a day order, which automatically expires if it's not filled by the end of the trading day, and a good till canceled (GTC) order, which remains active for a longer period, often 60 or 90 days, until it is either filled or you manually cancel it. To recap this chapter, the order types are your instructions to your broker. A market order prioritizes speed of execution over a specific price. A limit order prioritizes a specific price over the certainty of execution. And a stop-loss order is a tool that triggers a market order when a certain price level is reached. Understanding how these basic tools function is a key part of navigating the practical use of any investment app. In our next chapter, we'll learn how to read the information presented to us in the app. We'll break down the components of a stock quote, from the ticker symbol to the bid and ask prices. Thank you for listening. Hello and welcome back. In our last chapter, we got practical, learning the different instructions we can give our broker through market, limit, and stop orders. But before you can even place an order, your app presents you with a screen full of numbers and terms about the security you're looking at. This is the stock quote. At first, it can look like an intimidating dashboard of financial data. The goal of this chapter is to be your guide, breaking down each piece of that data, so you can understand what you're looking at. This is a chapter about definitions. We will be explaining what each term in a stock quote means. We will not be interpreting this data or suggesting how it should be used to make investment decisions. The analysis of this information is a deep and complex field, and our purpose here is simply to provide you with a foundational vocabulary. As always, this information is for educational purposes only. Let's build our understanding from the ground up, starting with the most basic identifiers. First, you have the ticker symbol. This is a unique, abbreviated code used to identify a company on a stock exchange. For example, the ticker for the Coca-Cola Company is KO, and the ticker for Microsoft Corporation is Microsoft. Think of it as the company's nickname on the stock market. It's much faster and easier to type a 1 to 4 letter ticker than a full company name. Next, you'll see the price. This seems straightforward, but it's actually more nuanced. The main price displayed is usually the last trade price, the price at which the most recent transaction occurred. But to understand the current market, you need to look at two other numbers: the bid and the ask. The bid price is the highest price that a buyer in the market is currently willing to pay for a share of the stock. The ask price is the lowest price that a seller in the market is currently willing to accept for a share of the stock. There is almost always a small gap between these two numbers. This gap is called the bid-ask spread. For example, a stock's bid might be $49.98 and its ask might be $50.02. This spread is essentially a small, built-in transaction cost and is a measure of the stock's liquidity. Highly traded stocks usually have a very narrow spread, sometimes just a penny. Moving on, you'll see a number for volume. Volume is simply the total number of shares of that stock that have been traded so far during the current trading day. It's a measure of how active the stock is. A high volume means many shares are changing hands, while a low volume indicates less trading activity. A very important piece of data you'll see is the market capitalization, often shortened to market cap. This represents the total value of the company according to the stock market. It's calculated with a simple formula: the current share price multiplied by the total number of a company's outstanding shares. Market cap is often used to categorize companies into size buckets, such as large cap, mid cap, and small cap. It essentially answers the question: what is the total market worth of this entire company? Now for two common metrics you'll almost always find. The first is the PE ratio, which stands for the price-to-earnings ratio. This ratio compares the company's current stock price to its earnings per share over the last 12 months. The PE ratio is a valuation metric. Investors often use it to get a sense of how the market is valuing a company relative to its profitability. For example, a PE ratio of 20 means that the stock is trading at 20 times the company's annual earnings per share. There is no universally good or bad PE ratio. Its interpretation depends on the industry, the company's growth prospects, and the overall market environment. The second metric is the dividend yield. As we learned in a previous chapter, some companies pay out a portion of their profits to shareholders as dividends. The dividend yield takes the total annual dividend per share and divides it by the stock's current price, expressing the result as a percentage. For example, if a stock trading at $100 per share pays an annual dividend of $2 per share, its dividend yield is 2%. This figure represents the return an investor would get from dividends alone at the current price. It's important to remember that many companies, especially high-growth ones, do not pay dividends. To recap this chapter, a stock quote is a snapshot of real-time market data. It includes the ticker symbol for identification, the dynamic bid and ask prices that form the market, the volume of daily trading activity, the market cap representing the company's total value, and metrics like the PE ratio and dividend yield which provide additional context. Understanding these terms transforms a confusing screen of numbers into a coherent dashboard of information. In our next chapter, we're going to zoom out. Instead of looking at individual stocks, we will explore how we measure the health and performance of the market as a whole by looking at major market indexes like the Dow Jones, S&P 500, and the Nasdaq Composite. Thank you for listening. Hello and welcome back. In our last chapter, we learned how to decode the dashboard of a stock quote, understanding the meaning behind terms like the bid-ask spread, market cap, and PE ratio. We focused on the vital signs of a single company. But what about the health of the entire forest, not just one tree? How do we get a sense of how the stock market is doing as a whole? The answer is by looking at market indexes. Every day on the news, you hear phrases like, the Dow was up 200 points, or the S&P 500 hit a new high. This chapter will demystify what those names mean. We'll explore the three most cited market indexes in the United States: the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. This discussion is for informational purposes only. A market index is a statistical measure, a benchmark. It is not an investment itself, and its daily movements should not be interpreted as a signal to take any specific action. Our goal is to help you understand what these tools are and what they represent, so you can better interpret the financial news you encounter every day. Think of a market index as a report card for a specific segment of the stock market. It's a curated list of stocks whose collective performance is used to represent the overall trend. No single index represents the entire market, and each one we'll discuss tells a slightly different story because of how it's constructed. Let's start with what many professionals consider the most important benchmark for the U.S. stock market: the S&P 500. The S&P stands for Standard & Poor's, the company that created it. The 500 refers to the fact that the index is composed of 500 of the largest and most influential publicly traded companies in the United States. Because it includes a wide variety of companies across all major industries, from technology and healthcare to energy and finance, it's considered a very good proxy for the health of the large-cap U.S. stock market. A key feature of the S&P 500 is that it is market capitalization weighted. As we learned, market cap is a company's total value. This weighting means that the companies with the largest market caps have a much bigger impact on the index's movement than the smaller companies in the index. So, a 1% move in a corporate giant will affect the S&P 500 far more than a 1% move in one of the index's smaller members. Next, let's look at the oldest and most famous index, the Dow Jones Industrial Average, often just called the Dow. Created in 1896, the Dow is much narrower than the S&P 500. It consists of only 30 large, well-established, blue-chip companies. These companies are chosen by a committee to be representative leaders in the American economy. The most critical difference in the Dow is that it is price-weighted, not market cap-weighted. This is a very important distinction. In a price-weighted index, a company with a higher stock price has more influence on the index's value than a company with a lower stock price, regardless of the company's overall size. A stock trading at $500 per share will move the Dow 5 times more than a stock trading at $100 per share, even if the $100 per share company is much larger in terms of market cap. Because of this methodology and its small size of only 30 stocks, many financial professionals believe the S&P 500 is a more accurate representation of the broader market. Still, the Dow's long history makes it an enduring and widely quoted fixture in financial news. Finally, we have the Nasdaq Composite Index. This index is much broader than the other two. It includes the vast majority of all stocks listed on the Nasdaq Stock Exchange, typically over 3,000 companies. Like the S&P 500, the Nasdaq Composite is market cap weighted. What really sets the Nasdaq Composite apart is its composition. The Nasdaq Exchange is home to a very large number of technology companies, from software and semiconductor firms to internet and biotech companies. Because of this, the index is heavily tilted towards the technology sector. While the S&P 500 provides a balanced view of the entire economy, the Nasdaq Composite is often viewed as a benchmark for the performance of the tech industry in particular. So, to summarize the key differences, the S&P 500 is a market cap-weighted index of 500 large U.S. companies, providing a broad view of the economy. The Dow Jones Industrial Average is a price-weighted index of just 30 large, established companies. And the Nasdaq Composite is a market cap-weighted index of over 3,000 companies, with a heavy concentration in technology. When you hear on the news that the market is up or down, reporters are using these indexes as a shorthand. They are valuable tools for seeing the big picture and understanding the general mood and long-term trends in the financial markets. In our next chapter, we will shift our focus from the technical aspects of the market to the human side of the equation. We'll explore the field of behavioral finance and discuss two of the most powerful emotions that can influence an investor's decisions: fear and greed. Thank you for listening. Hello and welcome back. In our last 10 chapters, we have built a solid foundation of technical knowledge. We've explored everything from what a stock is, to how to read a quote, to what the major market indexes represent. We've focused on the numbers, the mechanics, and the systems. But markets are not just driven by data and algorithms, they are driven by people. And people are driven by emotion. Today, we are shifting our focus from the external market to the internal one. We will delve into the field of behavioral finance, which is the study of how psychology affects the decisions of investors. Specifically, we'll talk about the two most powerful emotions that pull at anyone involved in the markets: fear and greed. As we explore these psychological concepts, it is essential to understand that this chapter is for informational and self-awareness purposes only. It is not financial advice or psychological counseling. We are describing common human tendencies that have been observed in markets for centuries. The goal is to provide awareness, not to provide a solution for managing these complex emotions. Let's start with greed. In a market context, greed often manifests as the fear of missing out, a powerful acronym you may have heard: FOMO. This is the feeling that arises when you see an investment's price skyrocketing. You hear stories on the news or from friends about how much money people are making, and an intense urge builds to jump on the bandwagon.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Lest you be left behind. This feeling can lead to a behavior known as herding. Just like a herd of animals, investors can sometimes abandon their own research and simply follow the actions of the crowd, assuming that the crowd must know something they don't. When fueled by greed, the focus shifts from the underlying value of an investment to the sheer momentum of its price. The primary motivation becomes the desire for fast and easy profits, which can lead to ignoring clear risks. This is the psychological environment that can inflate speculative bubbles. Now let's look at the opposite, but equally powerful, emotion, fear. Fear takes over when the market turns, and prices begin to fall. The same investment that seemed destined for the moon a few weeks ago is now plummeting. The dominant thought is no longer about potential gains, but about preventing further losses. This is where a cognitive bias called loss aversion comes into play. Researchers in behavioral economics, like Nobel laureate Daniel Kahneman, have shown that for most people, the psychological pain of losing a certain amount of money is about twice as powerful as the pleasure of gaining the same amount. Losing $100 simply feels much worse than gaining $100 feels good. This deep-seated bias can make it incredibly difficult to think rationally during a market downturn. Fear can lead to panic selling, where the primary impulse is to sell investments at any price simply to make the pain stop and get out of the market. The long-term plan is forgotten, replaced by an immediate and overwhelming need to avoid seeing account balances drop any further. These two emotions, fear and greed, often create what is known as the cycle of market emotions. At the peak of a market, when optimism is at its highest and stories of easy money are everywhere, greed is often the dominant emotion. This is the point of maximum financial risk as prices are high. Conversely, at the bottom of a market, after a significant decline when the news is universally negative and the future looks bleak, fear is the dominant emotion. This is often described as the point of maximum financial opportunity, as prices are low. Unfortunately, acting on these emotions can lead investors to do the exact opposite of what is financially prudent. They can be driven by greed to buy high, and then driven by fear to sell low. Recognizing these tendencies in ourselves is a part of developing financial literacy. These feelings are not a personal failing. They are a fundamental part of human nature. The apps we use are designed to be engaging, and seeing your account value change in real time can amplify these emotional responses. A flashing green number can spark feelings of excitement and greed, while a red, negative number can trigger anxiety and fear. To recap this chapter, the financial markets are not just a reflection of data, but also of human psychology. The powerful emotions of greed, often manifesting as FOMO and herding, and fear, amplified by the cognitive bias of loss aversion, can drive irrational decision-making. These emotions often move in a cycle, creating challenging environments for investors. Awareness of these natural human tendencies is a crucial, though often overlooked, aspect of understanding how markets truly work. In our next chapter, we'll continue this discussion by exploring the concept of developing a long-term perspective and the importance of having a plan, which can be a valuable framework for navigating these emotional tides. Thank you for listening. Hello and welcome back. In our last chapter, we explored the powerful, primal emotions of fear and greed, and acknowledged the profound impact they can have on an investor's decision-making. We saw how these feelings can create a cycle that encourages buying high and selling low. This raises a critical question. If we know that our own psychology can be a major headwind, what frameworks can we use to navigate these turbulent emotional waters? Today, we will explore a philosophy that is often presented as an antidote to short-term emotional reactions: the long-term perspective. We will also discuss the role of having a personal investment plan. It is crucial to state that this chapter discusses concepts and strategies, not personal recommendations. The idea of long-term investing is a well-established philosophy, but it is not the only approach, and its suitability depends entirely on an individual's goals and circumstances. This information is for educational purposes, to provide you with a broader context for the world of investing. Any personal financial plan should be developed with care, and often with the guidance of a qualified financial professional. So, what does it mean to be a long-term investor? It's less about a specific number of years and more about a mindset. A long-term perspective is the practice of focusing on the growth potential of your investments over a period of many years or even decades, rather than on their daily or weekly price fluctuations. The core idea is that while markets can be volatile and unpredictable in the short term, the long-term trajectory of the broad economy has historically been one of growth. This approach prioritizes what is known as time in the market over timing the market. Timing the market is the attempt to predict short-term price movements, to sell right before a drop and buy right before a rise. While this sounds appealing, a vast amount of historical evidence shows that it is incredibly difficult, if not impossible, to do this successfully and consistently. Missing just a few of the market's best days can have a significant negative impact on long-term returns. Time in the market, the cornerstone of a long-term approach, is about remaining invested through the market cycles, both the ups and the downs, to capture the overall long-term trend. This philosophy is powered by one of the most important mathematical forces in finance: compound growth. Compounding is the process where your investment's earnings begin to generate their own earnings. It's like a snowball rolling downhill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger at an accelerating rate. In investing, your initial investment, the principal, earns a return. The next year, you earn a return on both the original principal and the accumulated return from the prior year. Over many years, this effect can become incredibly powerful, but it requires the one ingredient that a short-term approach lacks: time. This is where the importance of a plan comes in. An investment plan, sometimes called an investment policy statement, is essentially a personal rulebook that you create for yourself before you start investing. It's a document that outlines your financial goals, your time horizon for those goals, and your personal tolerance for risk. Developing a plan involves asking yourself some fundamental questions. What am I investing for? Is it for a goal 30 years away, like retirement? Or is it for a goal 5 years away, like a down payment on a house? How much risk am I truly comfortable with? As we learned in Chapter 7, this is a deeply personal question. The true value of having a plan is that it serves as an anchor in an emotional storm. It is a logical framework that you built during a calm, rational moment. When the market is soaring and the feeling of greed is telling you to chase a hot stock, your plan might remind you of your predetermined risk tolerance and diversification strategy. When the market is falling and fear is screaming at you to sell everything, your plan can remind you of your long-term goals and your long-time horizon. It helps separate the immediate emotional reaction from the long-term, reasoned decision. A plan provides a basis for making decisions that is not dependent on the market's mood or the day's headlines. It helps transform investing from a reactive, emotional activity into a proactive, disciplined process. To recap this chapter, the philosophy of long-term investing focuses on time in the market, rather than attempting to time the market. It is fueled by the mathematical engine of compound growth, which requires a long time horizon to be effective. Creating a personal investment plan that outlines your goals, timeline, and risk tolerance can serve as a powerful tool to counteract the emotional impulses of fear and greed, providing a logical framework for decision-making. In our next chapter, we will revisit a critical and practical topic that affects every investor, regardless of their philosophy: the various fees and costs associated with investing, and how to understand their long-term impact. Thank you for listening. Hello and welcome back. In our last chapter, we discussed the power of a long-term perspective and the mathematical engine of compound growth, where your returns begin to generate their own returns over time. However, for that engine to run as efficiently as possible, it's crucial to minimize friction. In the world of investing, one of the biggest sources of friction is costs and fees. Today, we will revisit the topic of fees, taking a much deeper look at the various costs that can be associated with investing. While some fees are obvious, others can be less visible, and understanding their cumulative impact is a critical part of financial literacy. A small fee that seems insignificant today can have a surprisingly large effect on your results over the course of many years. This chapter is designed to be an educational guide to the types of costs you may encounter. It is not a recommendation for any specific product or platform. The fee structures of financial firms can and do change. The purpose here is to equip you with the knowledge of what to look for and what questions to ask when evaluating any investment product or service. Let's start with the most common cost for anyone who invests in funds: the expense ratio. We introduced this concept briefly in our chapter on ETFs, but it deserves a closer look. The expense ratio is an annual fee charged by fund managers to cover the costs of operating the fund, including portfolio management, administration, and marketing. It is expressed as a percentage of the assets you have invested in the fund. This percentage might seem small, perhaps 0.5%, 0.1%, or even as low as 0.03%. But let's see how it works with the power of compounding. Imagine you have $10,000 invested. If a fund has a 1% expense ratio, it will cost you $100 per year. If a similar fund has a 0.1% expense ratio, it will cost you only $10 a year. Now, imagine that effect compounded over 20 or 30 years. The fees not only reduce your principal, but they also reduce the amount of money you have available to generate future returns. It's like compounding in reverse. Over a long investment horizon, the difference in total returns between a high-cost fund and a low-cost fund can be substantial. Next are trading commissions. In the modern era of investment apps, we've seen a move towards commission-free trading, which is a major benefit for investors. This generally means that for buying and selling common stocks and ETFs, the brokerage does not charge you a direct, per-trade fee. However, it's important to read the fine print. Commission-free may not apply to all assets. Some brokerages may still charge commissions for trading other types of securities, like certain mutual funds or options, or for trades that are placed over the phone with a live broker. Beyond direct trading costs, you should also be aware of potential account fees. While competition has made many of these less common, they still exist on some platforms. These can include account maintenance fees, which are flat fees charged annually or quarterly just for having an account open. Some platforms may charge inactivity fees if you don't make any trades over a certain period. And a very common one is a transfer fee, sometimes called an ACATS fee, which is charged if you decide to move your assets from one brokerage to another. These are all things that are typically disclosed in a brokerage's official fee schedule document. This brings us to a more complex topic. If many apps don't charge commissions, how do they make money on those trades? One of the primary ways is a practice known as payment for order flow, or PFOF. It's a system where your brokerage directs your trade order not to a public exchange, but to a large trading firm known as a market maker. In return for this order flow, the market maker pays your brokerage a small fee, often a fraction of a penny per share. This is the business model that has enabled the zero-commission revolution. Proponents of PFOF argue that it lowers costs for retail investors and creates a more accessible market. However, the practice is also a subject of debate. Critics express concern that it could create a conflict of interest, where a brokerage might be incentivized to route orders to the market maker that pays them the most, rather than the one that would provide the absolute best execution price for the customer. This is a complex issue with ongoing regulatory discussion, but it's an important part of understanding the mechanics behind the free trading model. To recap this chapter, the total cost of investing is more than just the initial purchase price. It includes ongoing fees like expense ratios on funds, which can significantly impact long-term compounding. It can also include trading commissions on certain assets and various account fees. And the commission-free model is often supported by business practices like payment for order flow. Being a knowledgeable investor means being aware of all of these potential costs, both visible and hidden, and understanding how they can affect your financial journey over time. In our next chapter, we'll turn to another critically important practical topic: the steps you can take to keep your investment account safe in the digital age. Thank you for listening. Hello and welcome back. In our last chapter, we took a close look at the fees and costs that can create friction on your investment journey. We focused on protecting your returns from being eroded over time. Today, we turn to an even more fundamental topic: protecting your assets themselves. In our digital world, where your investment account is accessible from the palm of your hand, understanding and practicing good cybersecurity is not just a suggestion. It's an essential responsibility. This chapter will serve as a guide to the best practices for digital safety. The information we are about to cover consists of generally accepted security principles that apply to almost any online account, but they are especially critical when it comes to your finances. This is not financial or legal advice, but rather a set of educational guidelines to help you navigate the digital world more safely. Let's begin with the first line of defense: your password. The importance of a strong and unique password cannot be overstated. A strong password is not a simple word or a common phrase. It should be long, at least 12 to 15 characters, and include a mix of uppercase letters, lowercase letters, numbers, and symbols. The key, however, is the word unique. It is critical that the password you use for your investment app is not used for any other online service, whether it's your email or a social media account. When data breaches happen at other companies, hackers often take those leaked passwords and try them on financial sites. If you reuse your password, a breach at an unrelated website could lead to your investment account being compromised. Remembering dozens of unique, complex passwords can be a challenge, which is why many people use a reputable password manager to securely store them. The second, and perhaps most critical layer of security you can enable is two-factor authentication, often abbreviated as 2FA. You should enable this on your investment account immediately if it's offered. Two-factor authentication means that to log in, you need more than just your password. You need a second piece of information, creating two layers of security. This is typically based on something you know, your password, and something you have, your phone. The most common form of 2FA sends a one-time code to your phone via a text message. A more secure method, which you should use if available, is an authenticator app. These apps generate a constantly rotating code on your device itself. This is considered safer because it isn't vulnerable to having your text messages intercepted. With 2FA enabled, even if a criminal manages to steal your password, they will not be able to access your account without also having physical access to your phone. Next, you must be vigilant against phishing and social engineering. Phishing is a type of fraud where criminals send deceptive emails, text messages, or create fake websites designed to trick you into revealing your personal information, like your password or account number. They might try to create a sense of urgency or fear, with messages like, "Your account has been suspended, click here to reactivate," or "There has been a suspicious login attempt, verify your identity now." Here are some red flags to always watch for. Unexpected emails or texts asking for personal financial information. Your brokerage will never ask for your password via email. Messages with a tone of extreme urgency or threats. Emails with poor grammar, misspellings, or an unprofessional design. Links that, when you hover over them, show a web address that is different from the legitimate company's website. Unsolicited attachments you weren't expecting. The golden rule is, be skeptical. If you receive a suspicious message, do not click any links. Instead, go directly to the investment app or the company's official website by typing the address in your browser yourself. Another important practice is to be mindful of your network. Be very cautious when using public Wi-Fi, such as in a coffee shop or airport. These networks are often not secure, and sophisticated criminals can potentially intercept the data you are sending. For accessing your financial accounts, it is always safer to use a trusted, password-protected network like your home Wi-Fi, or to use your phone's cellular data connection. Finally, it's helpful to remember the two sides of security. The practices we've discussed today are your responsibility, your personal security hygiene. This works in tandem with the institutional security we've mentioned in past chapters, like SIPC insurance. SIPC protects your assets in the rare event that your brokerage firm fails. It does not protect you from losses if your account is compromised because of weak or stolen credentials. That is why your personal security is such a vital part of the overall safety of your assets. To recap this chapter, protecting your investment account requires a proactive approach. This includes using a long, unique password, enabling the critical layer of two-factor authentication, being constantly vigilant against phishing attacks, and using secure networks for financial transactions. In the digital age, being a responsible investor means being a security-conscious one. In our final chapter, we will bring everything together, summarizing the key lessons from our series, and discussing the next steps in your ongoing educational journey into the world of finance. Thank you for listening. Hello, and welcome to the final chapter of our series. Over the last 14 chapters, we have traveled from the most basic concepts to the more nuanced aspects of how U.S. investment apps work. We began with a simple question: how does this technology on our phones actually connect us to the vast world of finance? Our goal was never to provide a map telling you where to go, but rather to teach you how to read the map for yourself. In this concluding chapter, we will revisit the key landmarks of our journey and discuss the next steps in your ongoing financial education. Let's take a moment to look back at the ground we've covered. We started at the very beginning, establishing that an investment app is a user-friendly portal to a regulated brokerage firm. We demystified the process, learning how a few taps on a screen translate into real transactions on the world stock exchanges. We then built our foundation by learning how to evaluate the landscape of different apps, focusing on their philosophies, fees, and security features. We clarified the crucial difference between the containers for our investments, the flexible taxable brokerage accounts, and the rule-based, tax-advantaged retirement accounts like IRAs. From there, we began to fill those containers. We defined the core asset classes, understanding a stock as a slice of ownership, an ETF as a basket providing instant diversification, and a bond as a loan to a company or government. This led us to the core principle of the risk and reward trade-off, the fundamental concept that higher potential rewards are intrinsically linked with higher levels of risk. With this theoretical knowledge in place, we got practical. We learned the language of the market, from the different order types like market and limit orders, to decoding the data in a stock quote. We then zoomed out, learning to interpret the market's daily pulse by understanding the major market indexes like the S&P 500, the Dow Jones, and the Nasdaq. Finally, we turned our focus inward and toward the practical realities of being an investor. We explored the powerful human emotions of fear and greed, and how the field of behavioral finance helps us understand their influence. We discussed the long-term perspective, and the role of a plan as a logical anchor in an emotional sea. And we dove into the critical, real-world topics of understanding fees and costs, and practicing diligent digital security to protect your assets. The single thread connecting all of these chapters has been a simple, unwavering mission: to empower you with knowledge. The world of finance is filled with complex jargon and intimidating concepts, but as we've seen, every one of them can be broken down and understood. The purpose of this series was to give you a vocabulary and a set of frameworks, not to give you answers. It was designed to help you ask better questions, and to navigate your own research with a greater degree of confidence and clarity. So, what are the next steps on this journey? The most important next step is to embrace the idea that learning about finance is an ongoing process, not a destination. The markets and the tools we use to access them are constantly evolving. Committing to being a lifelong learner is the best investment you can make in your own financial literacy. Continue to seek out high-quality, educational resources. The Securities and Exchange Commission, or SEC, has a wealth of unbiased investor education materials on its website, as does FINRA. Many reputable financial news organizations, and the brokerage firms themselves also provide extensive libraries of articles, videos, and tutorials designed purely for educational purposes. And this brings us to our final and most important point, which we have stressed in every single chapter. This educational foundation is designed to prepare you to have more informed, more productive conversations with qualified professionals. The knowledge you've gained here can help you understand the advice you receive from a licensed financial advisor, who can legally provide guidance tailored to your unique personal situation. It can help you ask better questions of a tax professional about the implications of different account types. This series was created to be a bridge, to take you from a place of curiosity to a place of informed understanding. It is for informational and educational purposes only and is not, under any circumstances, financial, investment, tax, or legal advice. You have taken a significant step by dedicating your time to understanding the mechanics of these powerful tools. You've learned how the engine works, how to read the dashboard, and how to understand the rules of the road. The journey from here is yours to navigate. Continue to be curious, continue to learn, and continue to build upon the strong foundation of knowledge you now possess. Thank you for listening.
Disclaimer: the information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.